Welcome to another of the Learn-in-BYTES series, an initiative of the Caribbean Center for Organizational Excellence. In this session, we address the matter of break-even analysis. A little technical, but we believe that this is of importance for the success of your business. So we invite you to be honest on this short journey as we look at the matter of break-even analysis. So what is break-even? The term break-even, when used in business, finance, and more particularly cost accounting, refers to the point at which total costs and total revenue are equal. Said otherwise, it's the point at which a business neither makes a profit nor a loss. So why is this important? For one simple reason, it is a key element of cost planning and structuring for a business. And more importantly, it is a determinant for forecasting the level of business activity required to meet costs and remain viable. If we want to term that otherwise, if revenue is not commensurate with costs, a business fails. So understanding and appreciating at which point of production or which point of activity cost is being met is critically important to a business. In this regard, there are a few components that are really necessary for computing break-even analysis, of which are fixed costs. And fixed costs is that element of a business or cost within a business that doesn't fluctuate with the productive activity of the business. In other words, it remains stable and is independent of increases or decreases in the amount of goods or services being produced or sold. So fixed costs does not go to zero because production goes down, and whether or not production takes place, this is cost that has to be met by the business, and this is important to know. Irrespective of activity, this cost has to be met. The second element of costs required for calculating break-even is variable costs, and variable costs comparatively fluctuate with the productive activity of a business. And this is cost that's directly correlated to the company's production volume. So as production increases, so too does the cost of the business. Conversely, where production decreases, so too does variable cost in the business. And these two components, component one, which is fixed costs, and component two, which is variable costs, equate to what is referred to as total cost. And total cost is important for calculating that break-even point, and indeed analyzing the overall break-even position of a business. There is a third component which is also very necessary for computing break-even, and that is total revenue. And total revenue, by definition, is a calculation of the quantity of products sold at a determined price for each of the units in a business. So applying these component elements, a business is determined to break even when total cost equals total revenue. From an analytical perspective, in question, therefore, is how many products will a business need to sell, that is total revenue, to meet its total cost, that is the combination of fixed and variable costs within the business. So by example, let's say your business produces headphones and has a total yearly fixed cost of $60,000. There is a variable cost of $40 for producing each headphone, and let's assume that each headphone is being sold at a price of $100. The question is, what will be the break-even point for this business? So two approaches can be considered for calculating the break-even. One, the contribution method, and secondly, the total revenue total cost method. Let's look at the contribution method and how we can use that for calculating the break-even in your business. We would have already established that the selling price for each headphone is $100, As well, we established that the variable cost for producing each headphone was $40. To calculate the contribution, it is very simple. It's the selling price, $100, minus the variable cost, $40, and this equates to the contribution or the amount that is available to help cover fixed costs. As simple as that. It's the $100, the selling price minus the variable cost, $40, gives us the contribution for calculating the break-even point for the business. So the number of headphones to be sold to break even will be the total fixed cost, that is $60,000, divided by the contribution, $60, equating to 1,000 headphones, which would be required to break even in your business. So your business would need to have at least 1,000 headphones sold to make its break even point, or said otherwise, would have to sell the equivalent of $100,000, where $40,000 goes towards covering variable costs and $60,000 covering fixed costs in order for that break-even position to be realized. Using the total cost, total revenue method, break-even is calculated as total fixed costs divided by revenue per unit minus variable costs per unit. In other words, $60,000 divided by $100, which is the revenue per unit, minus the variable costs for producing each unit, and once divided by that sum, which is $60, the equivalent is 1,000 headphones, as was calculated using the contribution method. Simple and very easy to apply in business. So we want to encourage persons to take advantage of using break-even analysis to ensure that cost is properly analyzed and determined within your business. An important concluding note, however, is that some costs can be semi-variable. In other words, they comprise of both fixed and variable costs. And when we say that they comprise of both fixed and variable costs, you can have a situation where the cost is fixed up to a particular volume of production, and after that volume, the cost becomes variable. So it is referred to as semi-variable costs. And it's really important to understand if this is the experience of your business, and manage semi-variable costs as such can limit profitability at increased production levels. Said otherwise, increased production could result in diminishing returns, and managing the quantities produced is important to ensuring break-even and also ensuring profitability. So break-even is a useful tool for cost and profit management. It's really an excellent tool for analyzing costs at different output levels in your business and helping you to make good decisions that give rise to profitable outcomes. And so we encourage you to use a break-even in your business. So that's it for now. For more information or to request any of our services, feel free to drop us a line at admin@organizational-excellence.com. You can also catch us on Instagram, on Twitter, on LinkedIn, on Facebook, or feel free to visit our website at www.organizational-excellence.com. It was really a delight sharing on Breakeven Analysis with you. My name is DaC Blenman, Executive Director of the Caribbean Center. Looking forward to sharing with you some more in our Learn in BYTES series. Take care. Have an excellent day.